Hi, and welcome to Random Rogers Big Picture, special New Year's 2008 edition. Wanted to go over a couple of things today. One, kind of expand a little bit on this 10% solution post, which ties in with toll roads and alternative and absolute and all these other things that I've been trying to explore on the blog, that I've been trying to learn about as well, and in the interest of implementing for clients. Also talk a little bit, and I think I can make a tie-in if we have enough time, to a post from Seeking Alpha that had a whole bunch of Sharpe ratio stuff on a bunch of different sectors. Okay, so I put up a post talking about all sorts of different asset classes on Friday, absolute return ideas, allocating a portion to that, things like infrastructure, the toll roads, currency. There was a list of 7 of them. Merger funds was another one. And the idea, first of all, I would describe where I am as kind of wading in slowly. I've got, I don't know, 1 or 2 of these types of things for clients, depending on how broad you want to go with other. Maybe I've got 4 or 5. One person included gold in the other, and there's no right or wrong, so if you go by other, maybe I'm, 4 or 5 or 6, whatever. That doesn't really matter. The focus here is on some of these newer things, new to me anyway, in the last year or so, and how they tie in to a portfolio. So one question came in. My comment is how to reconcile with that, 10% and that was just a hypothetical number, and I kind of talked around that, saying it could easily be 15. But with David Swensen, he would allocate a much larger position, David Swensen from Yale, with, say, 20% to absolute return stuff and another 20% to real assets. And this person says that he likes, in this real assets category DBA and PCL. DBA I own, for disclosure. PCL is a pretty widely held client holding. I don't know about everyone, but pretty widely held, just to get the disclosure out of the way. Your approach is a much smaller number across both of these categories, and really more than just 2, at least as I read, what I wrote this morning. He says he uses Swensen's model as a jumping off point. Okay, and then later in the day, Jasper kind of got things going with, what about having cash in the, in a bear market, having a lot of cash, because things that are lowly correlated can still go down. All of this stuff is good stuff. First of all, to this comment about 20% in absolute and 20% in real assets, that may be right for, certainly David Swensen, if those are his exact numbers. I know that his numbers are quite high. And maybe it's right for this reader too. But these, just because they are simple businesses, a lot of them, they're not simple stocks. If you take a look at the website, I would say go to the websites, and you can find the URL from Yahoo Finance. If you go to the website, you're going to see that these are complicated companies with intricate financial systems where they're borrowing a lot of money. If you know about Macquarie, for example, they use a lot of debt and a lot of complicated financing to fund the dividend. It's a very, it's either sophisticated if you're bullish, or it's reckless if you're bearish on the bank, and then how that trickles down to the various funds that trade. MIC is a long-time holding. I think I just said, new to me in the last year. MIC I've had for I think close to 2.25 years, something like that. I think I bought it in fall of 2005, so I've had that one for quite a while, if my timing is precise, but at least a couple of years anyway. These are complicated businesses, and so what are you going to do? Either you can learn as best as you can, know that you might have limitations, and everyone has limitations, and not make a big bet. This Macquarie that I own, this MIC, I've disclosed it a zillion times in the past. Okay, it does pretty well, that ongoing, well-known threat notwithstanding. At some point, so the question becomes, not is the threat real or not, because I suppose it is a real threat. The question becomes, does it ever matter? And if it ever does matter, will it then at the same time matter to these other complicated infrastructure companies? Macquarie is obviously an infrastructure, more of a fund than a company, but does it matter? And when it does matter, will it matter to all of them? Kind of a baby with the bathwater, like what we're seeing with the financials this year. Financials that really have no fundamental link are getting taken down. So any one of those toll roads, if Macquarie implodes as a function of this dividend thing, first of all, I've got about a 2 or 2.5% weight. It's probably grown into a 2.5% weight. If it implodes and I totally miss it, and the common refrain, I say this over and over, well, that'll be a bummer, but at 2%, it probably isn't a huge obstacle to the portfolio. So if you go heavy in something like that, you're setting yourself up for a negative, as it came up in the comments, a negative black swan event. Something unforeseen happens to all of them, something ghastly. You have a real problem. Real assets, same thing. I foolishly speaking, love these things. You shouldn't be emotional about stuff. Absolutely love agriculture. A lot of clients have a stock that's in the realm. This DBA, I've disclosed before, will add a food commodity ETF, ETN thing sometime in the next couple of months. Absolutely love the theme, but here I'm thinking in terms of very little exposure. And, the other thing, the big macro to this is, over time, stocks still go up. So I don't want to diversify too far away from the thing that is probably going to go up, even if that means I have to go outside the U.S. to do it, which obviously is something I've been writing about since day one of the blog, something I believe in wholeheartedly. And I've said plenty of times I'm somewhere in the 30s percentage-wise to foreign. I can see that going up to 50 by the end of the decade, maybe more so into the next decade. So I don't want to get too far away from stocks, for all sorts of reasons I think I've touched on. Okay, I'm running short on time, so I'm going to hop right to this post, and I'll leave a link to it. I don't even remember what the guy's conclusions are, and as I'm looking at it here, I'm just looking at the chart, or table rather. He's got a bunch of different, I think there's 20 altogether, 14 sector ETFs, and then 6 style/cap size ETFs. And he's got the year-to-date Sharpe ratio for 2007 for all of them, and it swings all over the place. The point of my mentioning this, and I will leave a link, is learn about Sharpe ratio, take a look at what sectors did well this year, understand the environment in which they did well this year, maybe take a look back at some of the things, because this is an important part of what I do, or try to do, take a look back at some of the stuff I was writing about about where to go heavier or lighter in sectors, and you'll kind of see that a lot of the stuff I was talking about has panned out based on this guy's chart, and the stuff, it was all very simplistic, chapter 1 of the textbook type of analysis. So, point being, this is something that you can do. It very rarely is more complicated, and I'm going to use the same old example that I've been using for ages. Doesn't get much more complicated than inverted yield curve, bad for financials. Slowing economy, bad for discretionary. Slowing economy, good for staples. Most of the time, it is that simple. So much so that the off chance that it's wrong one time, it's not going to do unwieldy damage, assuming you're a person of moderation to begin with. That's about it. It's possible life as we know it may change depending on the outcome of this Patriots-Giants game, but hopefully we're still all here on Monday. Have a great weekend.